Happy Friday, traders. What an interesting way to end this week in markets. In the last 48 hours, we have seen lots of positive headlines with respect to the US and Iran conflict. And more specifically, that they are very close to making a deal. So first we heard from Trump. Trump has told us a couple of times in the last couple of days that we are in the final stages of doing a deal. And on the Iranian side, we've also heard from them saying that, yes, they are in deep negotiations at the moment. And the differences between the two, the gaps and the differences is narrowing a lot. So look, it looks as if they are working very hard to get some sort of draft deal to start off with. But having said that, we have had a lot of false alarms in the past, so we haven't actually seen a deal yet. But regardless, look, markets are reacting to these positive headlines. So the most important market, which is crude. So crude oil this week, it did start the week bid, and crude oil was spiking, and it did look quite dangerous what crude oil is doing, but obviously these headlines have got it lower. We're trading maybe a good $8 lower from the highs of the week and back below $100. So look, obviously that is a big positive, and it is a big stress relief for markets. But having said that, a lot of oil energy analysts are saying that even if we did open the strait, and if we did get a resolution very quickly now of this war, it's still going to take probably until Q1 of 2027 at some stage during that quarter before we see crude start flowing to pre-war levels. So look, we've still got a good time until the end of the year and early next year where we're still going to have some supply issues. So that means that there isn't a huge trade for crude, selling crude on the downside. It is not going to drop like a rock. And we're still going to see elevated levels for crude for quite some time. So yes, can it fall more? Yes, of course it can. I would imagine, look, down towards $90 and just below are probably levels where we're going to see some decent support, and certainly I would not be chasing shorts down towards those sort of levels. Okay, so if we have a look at bonds, what's going on in yields, yields this week and the last couple of weeks, we have seen them surging, seen them spiking, spiking up to dangerous levels where potentially we can start breaking things. So US 2 yields, we saw a high this week around about 4.15%. So the last couple of days of these positive headlines, that is lower. So we're at around about 4.07% at the moment. It's down about 8 basis points. So some stress relief there. 10 years, they went up to a whopping 4.7% and threatening to push up to 5%. So look, it is no surprise that these deals and all of this is happening when we're getting to these critical levels. And those deals are happening with some sort of urgency because no doubt Trump and his team know that these bond yields surging is going to create global chaos. In any case, 10s, now we're down around about 4.57%. So we're down a good 10 basis points from those highs. But look, yes, there's some stress relief with those bond yields. At least they've stopped them going higher. But look, if we look at where they were pre-war levels and where they've gone, for example, 10s below 4%, we're still a good 60 basis points above where we started. And we are only 10 basis points from the highs. So we're not out of the fire on these yields. Certainly they are still at very elevated levels, which is certainly a negative for global economies and for markets if they stay at these levels for an extended period of time. So keep an eye on those yields. But certainly at the moment, we're getting some stress relief. As far as equities are concerned, US equities, they've been on an absolute massive bull market run, and obviously we've made record highs recently. Positive headlines, bull markets, what do? They go back up again. So S&P, yes, it's back within the spitting distance of record highs, pushing back up towards 7,500. And Nasdaq as well. It's literally only 200 points from record highs. So obviously, yes, they could reclaim those levels and push higher at any stage in the short term because we are super close. As far as the currency market's concerned, yes, haven't seen any big moves there. So the US dollar has followed bond yields higher. So we've seen some good US dollar buying this week. Dollar index is above 99, went up to around 99.30. With those yields backing off a little bit, we've seen the US dollar sell off a little bit. Dollar index is but still above 99, it's around about 99.10ish. So no huge move selling the US dollar at the moment. And I'd suggest really what you're going to need is you're going to need crude to take another leg lower, and certainly then you're going to need those US bond yields lower. Get that, no doubt, then you're going to see more US dollar selling. But at the moment, the fact that we haven't seen a massive move in those bond yields, it's hard to get excited about being short USD at the moment. Finally, yesterday we did have RBA in Australia. Oh, sorry, not RBA. We did have Aussie employment numbers. Those numbers weren't good. So market was expecting headline to be around about plus 20,000 jobs added. Came in negative, minus 20. So not good there. That was a miss. And then also the unemployment rate. Market was expecting that to remain stable at 4.3%. It unexpectedly jumped up to 4.5%. So what's the key takeaway there? It's pretty much the market now is looking at 3 rate rises from the RBA this year is starting to have negative effects on the economy, and that potentially the RBA now may be at the peak of this small hiking cycle that we have seen. Anyway, weekend coming up. Obviously, there's gap risk. We still are in a very headline-driven market, and you would not want to see a headline saying that over the weekend, that for whatever reason, these talks are broken down again, because then obviously markets will gap much lower on Monday. It's happened before. Who knows whether or not it'll happen again. Anyway, good luck with the trades.